Topaz Energy Corp. TSX, TPZ, is a structurally unique entity within the North American energy sector, leveraging a hybrid royalty and energy infrastructure investment model to generate exceptionally high-quality cash flow. Unlike traditional exploration and production (E&P) companies, Topaz acts primarily as a passive, non-operator investor, focusing on acquiring low-risk, stable, and predictable revenue-generating assets. This differentiated approach, which merges high-margin royalty interests with fixed-fee, stable infrastructure assets, significantly mitigates operational complexities and commodity price volatility, establishing Topaz as a premium investment within the energy sector. The core investment thesis hinges on the superior conversion of revenue into free cash flow, FCF, driven by an operational framework that externalizes the majority of capital expenditure requirements. This capital-light model underpins Topaz's financial stability, enabling it to deliver a compelling and sustainable dividend yield, currently situated around 5.3% to 5.4%. Synthesis of Q3 2025 financial performance. The third quarter of 2025 reaffirmed the strength of this model. The company reported robust financial results, generating total revenue of $76.4 million. Crucially, cash flow, a non-GAAP measure commonly used in the sector, reached $74.8 million, or $0.49 per share, with free cash flow, FCF, amounting to $73.0 million, or $0.47 per share. Both cash flow metrics confirmed a robust 7% increase on a per-share basis compared to the prior year period. The financial quality is perhaps best encapsulated by the exceptional FCF margin, which improved to 95% in Q3 2025, an increase from 88% reported in the previous year. This metric confirms that nearly every dollar of revenue is converted into deployable, discretionary cash, significantly reinforcing the structural safety of the dividend and the company's capacity for funding strategic acquisitions without undue strain on the balance sheet. Summary of financial positioning. Topaz maintains a disciplined and conservative capital structure, which enhances its financial flexibility. Management has consistently guided toward a highly conservative leverage profile, projecting the year-end 2025 net debt-to-EBITDA ratio to be approximately 1.5x. This conservative positioning ensures access to capital markets and provides a stable foundation for the dividend policy, which remains comfortably covered by the company's targeted payout range, projected at the lower end of 60% to 90% for the full year 2025. Topaz Energy's strategic framework, the hybrid advantage and associated risks. Topaz's foundational strength derives from its dual revenue streams, which are strategically concentrated across Canada's most productive resource plays, including the NEBC Montney, the Clearwater, and the Alberta Deep Basin. This dual focus allows Topaz to harness the upstream potential of oil and gas production while enjoying the midstream stability of fixed-fee assets. Operational model and asset segmentation. The company's portfolio is divided into two core pillars: extensive gross overriding royalty interests and strategic energy infrastructure ownership. A critical aspect of the royalty segment is that a significant portion of its acreage remains undeveloped, providing a long runway for substantial organic growth. The royalty arrangement stipulates that leading Canadian energy producers, who act as non-Topaz operators, bear all capital and operational costs associated with development and production. Topaz, in return, receives revenue based on gross production, without incurring any lifting or maintenance expenses. The structural benefit of this non-operator role is reflected dramatically in the profit margins. The royalty business generates an exceptional 92% cash flow margin, while the infrastructure segment, which relies on long-term fixed contracts and high utilization rates, delivers an 81% cash flow margin. This profound margin advantage compared to typical E&P or traditional midstream companies is the primary economic driver justifying Topaz's premium status. The economics of externalized growth. Topaz's growth strategy relies heavily on two mechanisms: disciplined acquisitions and operator-funded development. The organic growth potential is uniquely capital efficient. Topaz's 15% year-over-year royalty production growth achieved in Q3 2025 was entirely driven by the activities of its counterparties. The scale of this externalized funding is substantial. Operators invested an estimated $2.0 billion to $2.1 billion across Topaz's royalty acreage during the first 9 months of 2025. This high level of external capital deployment functions as a non-dilutive source of funding for Topaz, allowing the company to realize volumetric expansion without tying up its own precious free cash flow. This operational dynamic effectively shifts the capital allocation challenge away from Topaz, allowing the company to sustain its remarkable FCF margin. The success of the investment thesis is thus directly tied to the continued capital confidence and execution capabilities of these high-quality counterparty operators in developing the Western Canadian Sedimentary Basin. Continued high activity is anticipated, with guidance confirming expectations of 27 to 31 active drilling rigs operating on Topaz's royalty lands in the fourth quarter of 2025. Counterparty concentration and risk assessment. While the strategic alignment with high-quality producers is a source of strength, it also introduces the most single point of risk: counterparty concentration. Topaz was founded via assets acquired from its key counterparty, Tourmaline Oil Corp, which remains a major shareholder, holding 21.3% of common shares as of mid-2025. Furthermore, the recent September 2025 acquisition of NEBC Montney royalty interests further aligns Topaz to Tourmaline's multi-year development plan. Financial analysts argue that Topaz's dependence on just 3 major operators accounts for approximately 75% of its overall royalty activity. A structural vulnerability exists in this setup: a severe, coordinated slowdown in capital expenditure by these 3 primary partners, perhaps stemming from adverse regulatory changes, sustained weak commodity prices, or unforeseen financial distress among the producers, would immediately threaten Topaz's organic growth pipeline. Given that the company's valuation relies heavily on perpetual, externally funded growth, this risk must be actively monitored by investors. Mitigation rests primarily on the quality of these counterparties and the extensive, largely undeveloped nature of the royalty acreage, which offers multi-year drilling inventory. Comprehensive analysis of the income statement, IS. The income statement analysis for Topaz is dominated by its structurally unique expense profile and the measures taken to manage commodity price exposure. Q3 2025 top-line performance and drivers. Total revenue for Q3 2025 amounted to $76.4 million. While this figure reflects year-over-year growth in underlying volumes, it fell short of the anticipated consensus forecast of approximately $85 million, indicating a modest impact from realized commodity prices or slightly tempered royalty production compared to market expectations. The revenue mix demonstrated resilience, especially in the infrastructure segment, where processing revenue increased 16% year-over-year and 5% quarter-over-quarter, reaching $21.2 million. This infrastructure revenue provides a stable foundation, counterbalancing some of the volatility inherent in the royalty segment. Within the royalty division, the revenue mix for Q3 25 was derived 49% from crude and heavy oil royalties and 20% from natural gas and natural gas liquids, NGLs, confirming Topaz's balanced exposure to both liquids and gas in the WCSB. Expense structure and the low-cost base. The most notable feature of Topaz's income statement is its inherently low cost of sales. Since the operator-funded royalty model dictates that producers bear all lifting, drilling, and operational costs, Topaz's cost base is almost entirely limited to general and administrative (G&A) and non-cash charges like depletion, depreciation, and amortization (DD&A). This operational insulation is powerful. Despite the noted top-line revenue miss, Topaz managed to report earnings per share of CAD $0.1, significantly outperforming the analyst forecast of $0.0642. This simultaneous revenue shortfall and EPS beat underscores the company's superior operating leverage and low fixed cost structure. The royalty structure successfully shielded the bottom line from moderate revenue pressures, allowing the exceptional gross margin to flow through, reinforcing the intrinsic resilience of the business model against marginal commodity price shifts. Commodity risk management through hedging. As a recipient of commodity-linked revenue streams, Topaz is exposed to market risk, including fluctuations in commodity prices and interest rates. Management utilizes financial derivative contracts as a risk management technique to mitigate commodity price volatility. The hedging strategy is measured. Approximately 30% of Topaz's natural gas production is hedged at a price of CAD $3.06 per thousand cubic feet, MCF, and 30% of its oil production is hedged at CAD $97.64 per barrel. This partial hedging approach is strategic, balancing downside protection with the capacity to participate in commodity price upside. However, the company remains materially sensitive to market shifts. Corporate guidance estimates that cash flow is sensitive by approximately plus or minus 8% for every $1 per MCF fluctuation in AECO natural gas prices, and plus or minus 4% for every $5 per barrel fluctuation in WTI oil prices. While hedging provides a valuable protective floor, sustained material weakness in the underlying energy price environment could still exert margin pressure, confirming the necessity for management to remain disciplined in navigating market cycles. IV. Robust review of cash flow statement dynamics. The analysis of Topaz's cash flow statement confirms the exceptional quality and predictability of its cash generation, which is central to the entire investment case. The focus here shifts to the critical non-GAAP metrics, adjusted funds flow and free cash flow. Cash flow conversion excellence. Topaz's Q3 2025 results highlight its superior ability to convert revenue into cash. The company achieved cash flow of $74.8 million and realized $73.0 million in free cash flow. The FCF margin, which hit a remarkable 95% in Q3 2025, is the defining characteristic of Topaz's financial value proposition. This conversion rate is vastly superior to that of typical E&P industry peers, whose FCF margins often hover around 20 to 25%. The high FCF margin is a direct outcome of the royalty structure, where the costs associated with maintaining production, maintenance capital expenditures, are entirely borne by the operators. This structure ensures that Topaz's cash flow is not burdened by high, often cyclical, reinvestment demands. This quality renders Topaz's cash flow structure uniquely high quality, predictable, and immediately available for discretionary purposes, such as shareholder returns or strategic acquisitions. Capital expenditures and external funding. The unique economic architecture eliminates the need for significant internal capital expenditures. This efficiency allows Topaz to generate an outsized FCF relative to its revenue. The sustainability of this model rests entirely on the continued robust investment from Topaz's counterparties. This external funding is not a risk to Topaz's balance sheet. Rather, it is a lever for growth. The expected operation of 27 to 31 drilling rigs across Topaz's royalty acreage in Q4 2025 demonstrates the sustained confidence and capital deployment by these partners. This robust pipeline of activity guarantees future royalty production volumes, which is essential for maintaining and growing the FCF base into 2026 and providing consistent dividend coverage. V. Assessment of the balance sheet and capital structure. Topaz is committed to a conservative balance sheet management strategy, utilizing debt primarily to finance strategic acquisitions and maintain financial flexibility rather than to fund maintenance capital. Net debt and leverage strategy. The company maintains prudent leverage ratios. As of the end of Q2 2025, Topaz reported net debt of $485.2 million, a slight decrease from $492.0 million at year-end 2024. Reflecting the strategic capital deployed during Q3 25, management projects the year-end 2025 net debt level before incremental acquisitions to range between $500 million and $510 million. This debt management is coupled with disciplined leverage targets. Topaz expects to exit 2025 with a net debt to EBITDA ratio of 1.5x. This ratio is notably conservative, particularly for a company whose cash flows exhibit characteristics similar to stable midstream or infrastructure businesses. Management has explicitly stated that maintaining low leverage, targeting the lower end of the targeted long-term payout ratio, is designed to preserve financial flexibility for future acquisition-led growth. Liquidity and available capacity. Topaz maintains substantial liquidity via a syndicated credit facility, which was expanded to $500 million and includes an additional accordion feature of $200 million, available subject to agent consent. The low current leverage ratio ensures that the company has significant unused capacity, allowing it to mobilize capital quickly to execute accretive, disciplined acquisition opportunities consistent with its growth strategy. Analysis of debt maturity risk, critical issue. A critical technical issue for investors to consider is the maturity profile of the company's debt. Documentation indicates that the primary syndicated credit facility was previously extended with its maturity date set for December 2025. Given that the projected year-end net debt, $500 million to $510 million, utilizes the entirety of the primary $500 million facility, the imminent December 2025 maturity introduces a required near-term refinancing or renewal event. Although Topaz's excellent credit standing, strong cash flow conversion, and low leverage ratio make the successful renewal of this facility highly likely, financial analysts require timely confirmation of this extension. Elimination of this impending refinancing requirement is necessary to resolve any near-term technical uncertainty regarding liquidity and to maintain full investor confidence heading into 2026. V. Dividend safety and sustainability. Topaz's dividend is not merely an attractive component of its shareholder return model. It is structurally embedded and supported by the quality of the underlying cash flow. Dividend policy framework. The company's primary strategic focus is generating free cash flow growth and paying reliable and sustainable dividends. This commitment has resulted in 70% dividend growth since the company's initial public offering (IPO). The dividend policy is subject to quarterly review by the board of directors, taking into account earnings, financial requirements, and other prevailing factors. At the Q3 2025 share price, the dividend represents an attractive trailing annualized yield of approximately 5.3% to 5.4%. Payout ratio coverage analysis. Dividend coverage is assessed using adjusted funds flow, AFF, the standard discretionary cash metric in the Canadian energy sector. For Q3 2025, Topaz paid a dividend of $0.34 per share. This payout resulted in a 70% payout ratio relative to AFF. Over the longer term, the year-to-date 2025 coverage was slightly tighter, recording a 65% payout ratio. Crucially, these coverage metrics sit comfortably within management's stated long-term targeted payout range of 60% to 90%. Furthermore, the company's confirmed 2025 annual guidance specifically targets a 66% payout ratio, placing the expected annual payout at the lower, more conservative end of its stated range. Conclusion on dividend sustainability. The consistently conservative operation within the lower quartile of the targeted payout range is a deliberate strategic choice. By retaining 30% to 35% of its AFF internally, Topaz builds a substantial safety cushion that reinforces dividend stability. This buffer allows the company to absorb potential short-term adverse impacts from commodity price declines or temporary fluctuations in royalty volumes without threatening the current dividend level. The dividend is structurally robust and highly safe because it is supported by the unique nature of the company's FCF. The fundamental absence of significant internal maintenance capital demands due to the externalized capital expenditure model removes the most common threat to energy sector dividends, making Topaz payout exceptionally resistant to cyclical downturns. The FCF quality and margin superiority provide ample liquidity to sustain the dividend for the foreseeable future, making it a reliable income vehicle in the energy space. V. Valuation and investment conclusion. The valuation of Topaz Energy Corp must be approached with the understanding that the market prices its financial structure, not merely its underlying commodity exposure. Current valuation and multiple justification. Topaz trades at a notable premium compared to both E&P and many traditional midstream operators. Key valuation metrics indicate an enterprise value to EBITDA multiple of approximately 13.4x. This elevated multiple is a direct capitalization of the company's financial quality. The premium is justified by the predictability, resilience, and unique capital efficiency inherent in its business model. Investors are willing to apply a lower discount rate to cash flows that exhibit a 95% conversion margin and minimal internal capex demands. The market effectively prices Topaz not as a typical volatile commodity producer whose cash flows are subject to heavy reinvestment requirements, but rather as a growth-oriented, high-yield financial conduit whose FCF is immediately deployable. The high multiple thus reflects the market's capitalization of future cash flows at a lower perceived risk profile than its peers. With a market capitalization of $3.9 billion and an enterprise value of $4.4 billion as of mid-October 2025, Topaz has achieved significant scale reflecting this positive view. Analyst consensus and embedded upside. The financial community widely recognizes the value proposition, with analyst consensus suggesting significant potential upside from current trading levels. Analyst average 12-month price targets range from USD $22.15, implying a 24.81% upside from a share price of $17.75 in late October 2025, to a Canadian consensus average of CAD $31.52, suggesting 18.94% upside. This strong consensus and embedded upside are strongly supported by the company's guidance. The expected range for average annual royalty production remains firm at 21,000 to 23,000 BOE per day for 2025, alongside stable projected processing and other income of $88 million to $92 million. The sustained drilling activity expected on the royalty acreage, 27 to 31 rigs in Q4 2025, confirms a reliable pipeline for organic growth, which is central to realizing analyst projections. Summary of risks and final assessment. While Topaz's structural advantages are undeniable, the investment is subject to two principal risks. The primary concern is counterparty concentration. Despite the high quality of the partners, the substantial dependence on just three major operators for approximately 75% of royalty activity introduces a strategic vulnerability to the equity story. Secondly, although mitigated by partial hedging, Topaz remains exposed to volatility in commodity prices, natural gas and oil, which can materially impact cash flow. These risks, however, are effectively tempered by the company's defensive financial positioning, the superior FCF margin, the conservative leverage ratio targeting 1.5x net debt to EBITDA, and the substantial safety cushion provided by operating the dividend payout ratio at the lower end of the target range. Topaz Energy Corp offers a fundamentally sound and attractive investment proposition. Its hybrid model successfully delivers high-margin, stable cash flows and externally funded growth, which collectively justifies its premium valuation. The company's dividend is exceptionally secure, driven by the quality and predictability of its free cash flow. We maintain a favorable rating, contingent on the successful and timely confirmation of the renewal of the syndicated credit facility, scheduled to mature in December 2025. The long-term investment viability remains rooted in the unparalleled conversion rate of revenue to high-quality discretionary cash flow.